Welcome to another Mr. James accounting tutorial. This time we are looking at accounting unit 1 of HIP, and I'll be doing the entire series of past paper from 2013 right down to 2019, and there was no paper in 2020. If you haven't yet subscribed, now would be a good time for you to do so you can receive notifications or when these videos will be released. So let's get right into it. Part E. I. Explain the meaning of the following terms as defined in the IASB conceptual framework for the preparation and presentation of financial statements. 1. Verifiability, and then prudence, 4 marks. And then, according to the framework, explain two characteristics of relevant information that make the information in financial statement relevant to users. Okay, first we look at verifiability. Verifiability, the information must be capable of being tested. Proof of its faithfulness or falsity must be available. It must be traceable to the source documents evidencing its underlying transaction. So we have prudence. Prudence means when preparing accounting information, the accountant should take a conservative approach. Profits or revenues should be recorded only if they are earned, while losses or expenses should be recorded as soon as they are foreseen or you become aware that you have incurred them. First thing about relevance, we should define what relevance means. Relevance information is relevant when it has the ability to influence the decisions of its users. Okay, so if it cannot influence your decision as a decision maker, then it is not relevant information. Okay, two characteristics of relevant information are predictive value. Users must be able to use it to predict future outcomes of their decisions. And confirmatory value, users must be able to use it to confirm the results of past decisions. Okay, there are also other characteristics like timeliness. It must be prepared as close as possible to the year-end date to be relevant. Okay, if it's prepared too long after the period that it pertains to, then its relevance becomes questionable. Before we continue, just a brief reminder that if you haven't subscribed yet, you can still hit that red button before 2013 to 2019 paper 2 module 2 comes out next week. You can get notification of the date and the time. Okay, let's get on with it. Welcome back. I, this 3 years now, I have been wondering why they had this section in Part B here. Noel Sr. and his sister owned a company named Le Petit, which was incorporated 5 years ago. The company operates a fine dining restaurant in the town of Hampstead. It employs 30 persons. Capital invested by the family from their savings was 1,500,000. In addition to a loan from BLD Commercial Bank for 4 million. Over the past 2 years, the company has had significant growth in terms of daily patrons as well as private events. At a recent management meeting of the company, the board also decided to recruit an internal auditor and recommended the appointment of an external auditor to the shareholders. Okay, the first thing the access is for is two principles of internal controls concerning the management of cash. Okay, now all that we just read up here in thing, I didn't use it at all in the any of the questions here below. So it's 3 years now. I'm wondering what it is they give us this piece of information for. Okay, so they give us two internal controls for cash, physical, mechanical, and electronic controls, and segregation of duties. And they want us to list two other principles that could be recommended to the company. Okay, they just want us to list it. We are not explain or anything of the sort. So, two principles of internal control concerning management of cash. One, you can establish responsibility for different tasks concerning cash. Two, you can have proper documentation of transactions with source documents being used. Okay, I'll give you another two to go with those. Three, independent checks and internal verification. Independent checks means that senior management person not involved in the cash system would check on it from time to time. And internal verifications mean that it is that things are verified internally within the business itself without resource to outside information. And we have periodic surprise cash counts. From time to time, a senior officer not involved in the cash again will make a surprise cash count of the cash registers and the amount of cash they have in there and see that they are properly balanced. The next part of the question says describe two procedures to be implemented for each of the four principles given as well as recommended in B. Okay, so they give us two and they want two each for those, and the two that we gave, they want two principles for that as well. So, two procedures to be implemented for each principle. For the physical, mechanical, and electronic controls, you can have fireproof safes and vaults for storing your cash before it is taken down to the bank. And B, secure cabinets for keeping checkbooks. Right? You don't want your checkbooks lying all around, so you're gonna have to have secure cabinets. Otherwise, people are going to get their hands on it and they are going to write checks for themselves. Uh, Fireproof safes and vaults for storing of the cash. These to keep it out of the keep it out of the reach of unauthorized persons, as well as to prevent fires or things like that. Okay, now these controls, they must be in relation to cash. Okay, you cannot give controls in relation to stock or accounts receivable here, right? Segregation of duties. Persons making out checks should not be placing purchase orders. That is, people who are paying should not also be buying, otherwise, they're going to buy things for themselves. B. Cashiers handling cash should not be responsible for recording accounts receivable. Okay, so if you are handling the cash, you should not be recording as well. Otherwise, you may forget to record some and take them away. Two, now these are the two that we provided. Establishing responsibilities for task. Okay, you could require cashiers to sign registers tally or total for daily takings. Okay, they must sign it as having taken that amount of cash. B, we must assign each cashier a personal money tree. Okay, we might not be able to afford a separate cash register for each cashier, but what we can do is we can have a tray in the cash register for each cashier. So each cashier would be responsible for their personal tray. And then we have 4 documentation procedures. We use pre-numbered documents for cash sales and cash receipts. Notice again, it's cash we're talking about. And we want pre-numbered cash bills and receipts for when we receive cash so that if any go missing, we can easily trace the numbers. We timely recording of source documents once they have been prepared. Okay, so we must record those source documents in our books of original entries, and you must do it on time. Before we continue, just a short reminder, if you haven't yet subscribed, now may be a convenient time to do so, so you can get information or notification of dates and times of the upcoming 2013 to 2019 Paper 2 Module 2 Unit 1. Part 3 here says outline 3 differences between an internal auditor and an external auditor. Okay. 3 differences between an internal and external auditor. Number 1, the internal auditor is appointed by management, while the external auditor is appointed by the board of directors acting on behalf of the shareholders. Secondly, internal auditors report to the board of directors, while external auditors report to the shareholders. And thirdly, the internal auditor is an employee of the company, while the external auditor is independent of the company, the board of directors, and the shareholders. Okay, so we're looking at the differences in 3 things in terms of appointment, in terms of who they report to, and in terms of independence, whether they work for the company or they are independent. The statement of financial position of Liptite at 31st December 2015 was as follows. Ordinary shares at $5, 250,000, share premium 125,000, and retained earnings 400,000. During 2016, the following transactions occurred. We are given 5 transactions here and told to prepare journal entries without narratives to record the transactions. Okay, now if you notice something here, and each of the papers that we have done so far, each of the past paper, you have always had journal entries on different types of things. So it's something you should note for your exam. And journal entries seem to come every year. Journal entries without narratives. Okay, 12th of March, repurchase 2,500 own shares at $7 per share. Now, when you repurchase your own shares, it is called Treasury shares, and it works just like any other share. You put it in Treasury shares. All right, it's not an investment because it is in your own company, and you credit cash for 17,500. 2,500 by 7 gives us 175 and 2 zeros, 17,500. On the 16th of June, we issued 4,000 ordinary shares at $6.50. That will be 6 by 4 is 24, and 50 by 4, that's 2,000. So we'll get 26,000 in all. So we'll collect 26,000 in cash. And how much should we put the ordinary shares? Ordinary shares is $5 each, so 4,000 by 5 will give us 20,000 for ordinary shares, and the share premium 6,000. The remainder. A gentle reminder again, if you haven't subscribed, before we continue, you can subscribe to get notification of dates and times. They will come in next 2013 to 2019 paper 2 module 2. Okay, final 3. 23rd, 25th of September, paid interim dividend of 20,000. Journal entries without narrative. 25th of September, dividend. Okay, notice is just plain dividend, or if you want to call it interim dividend or dividend paid, but you cannot have payable because they paid it. Okay, 20,000, and this is cash. So we credit cash of 20,000. On 31st of October, paid interest of 5% debenture of $100,000. Now, this is one of those vague type of transactions that sometimes show up. You are not sure whether the 5% is 5% debentures or whether the interest is 5%, okay, of the 100,000, or whether the entire 100,000 is interest. Okay, so with something like this, you should state what you are doing. I am going to take it as 5% interest on the 100,000. You will get 5,000. 31st October, interest expense would be debited with 5,000 and cash with 5,000. And last one, 31st, I have a wrong date there. Purchase 2,000 ordinary shares in Carib Garage at $3 each as an investment. So 3 twos are 6, so we debit the investment in Carib with 6,000 and we credit cash with 6,000. If this video was useful to you, please give it a thumbs up. If you'd like to see more like it, leave a comment in the box below. And please consider subscribing if you haven't subscribed yet, so that you can receive notifications of upcoming videos, and hope to see you in the next video.